Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
President Donald Trump is getting ready to announce some auto tariffs. That is expected to come at 4 p.m. today. We heard that from the White House spokesperson. This would be a move that would certainly escalate his fight with global trading partners ahead of a broader tariff push next week.
We're expecting comments from the White House at 4 o'clock. We will bring the president's comments to you live as we do get them. In the meantime, U.S. tariffs on copper imports could be coming within several weeks, months earlier than the deadline for a decision. Also, according to people familiar with the matter, copper trading in New York rose to a record as a result. With a tariff roundup, back with us is Bloomberg News Metals and Mining heavy machinery reporter Joe Deaux, who joins us here in the studio. Usually I have this little chart, Joe, that keeps me up to date with the tariffs, the who, the what, the where, and the when.
Yeah.
But fortunately, we got you in the studio today, and that's much better than my little cheat sheet.
It's a lot, right?
It's a lot.
It's like even like if you're on the weekends hanging out with like friends who don't care about markets, they're like, "Oh, tariffs. Do you want to talk about tariffs?" I mean, that's how it's just become like part of the conversation in the U.S. Right? Is like one thing everybody knows is happening. Beyond the Signal story that happened the other day is tariffs.
Well, to that point, we see it hit consumer sentiment.
Yeah.
And when you see consumers cite this stuff as a reason that they're concerned, it's reaching a level that typically financial news doesn't reach when it comes to everyday people.
Yeah, and I think, listen, this is where it's important for us when we're doing these stories to kind of keep in mind, like, what is the consumer impact? So copper, for example, this report that we had last night, we've been working on now for a little bit. We had started hearing, wow, actually these tariffs might be coming sooner than expected. Now, to put that into context is a little wonky. When we got steel and aluminum tariffs in 2018, the President of the United States announced in 2017 that he was doing these so-called Section 232 investigations to put tariffs on steel and aluminum imports because they had feared that the import market was impacting national security. At the time, like, nobody had heard of this. Like, when we first talked about this, you guys might not remember it. I do. It was like, what is Section 232 and how can we claim this thing? Well, now it's very well known and the markets know it very well. And Donald Trump knows it very well. And what Donald Trump knows is that Section 232 is not only an executive power that he has, but one that he implemented and one that was tried by the courts. And the court said last time around, yeah, all of this is legal. This is exactly the power that he has. We talked about this when he re-implemented the Section 232 aluminum and steel tariffs just last month when he put the 25% on, or earlier this month. And that brings us to copper. Copper was not among any of the investigations in the first term. And when Trump brought up that he wanted to do copper tariffs, he said it when he was talking about the Canada-Mexico stuff. I know we're getting into it, but he said it in his quote-unquote State of the Union address, where he said, we're going to do copper as well. It was a weird one because he had just announced an investigation in Section 232 on copper, but he said in the conversation, well, we're going to do these tariffs.
He did. He did.
Right, which was a bit of a slip of the tongue because he still needs to wait for his Commerce Department to do the investigation. The investigation goes 270 days long, but we've learned from our sources that the market should expect this to come much sooner. In fact, what our sources were telling us was you're going to hear some sort of decision within weeks, not months. The market was expecting months. What month exactly? Unclear. But Goldman Sachs had been saying, we expect a 25% tariff on copper.
Right.
Sometime at the end of the year is kind of how they phrased it in notes to their clients earlier this week.
Well, it's a lot earlier.
It's going to be a lot earlier, according to our sources.
So what's the impact of that? And remind us, forgive us, because I know you're so good at like reminding everybody for this, in this example, like what the copper market is, what's the U.S. exposure to it, what we do. Remind us what it is and what impact it might have.
So we consume 1.8 million tons of copper per year in the United States. That copper is one of the most ubiquitous metals. It's used in everything. Your iPhones, your laptops, these microphones, the wiring in your house, the wiring in your car. It's everywhere. You touch copper at some point every day in your life. So in terms of tonnage, it's not the size of steel, but it is quite important. So it's 1.8 million tons. Half of that we import. So it's about 900,000 tons we require to import. What really happened in the market is, you need to remember, demand across the economy is lackluster. So it's not like we're having this big explosion in demand in the United States for appliances, for cars, like everything's just kind of there. But we have seen a trade happening in the market. The rest of the world understands that there could be a 25% tariff put on copper in the United States. Well, there's copper all over the world. So traders have been playing this by saying the copper price in the United States is about $11,500 per ton. Mm-hmm. In London, it's about $10,000 per ton. So why wouldn't you just take that physical metal, ship it into the United States, and catch the arb window? And that has been the story now for weeks. Well, now everybody's realizing that there might be an earlier end date for when you need to get in under the tariffs. And that's what a lot of the bank analysts were reporting on today was, listen, if there's a shorter timeline for when President Trump expects to announce the tariff, then that arb should eventually close, right? Like if the arb is at like a 19% spread, right? Then eventually 25% is what the spread would be. And then the arb is done.
Joe, you said, forgive me, you said half of the copper that we use in the U.S. we import, and we get half of it from the U.S.
So about half of what we consume is produced U.S. Domestic, exactly, and then the other half comes from abroad.
So is there enough copper supply in the U.S.?
No.
To satisfy
the need? Absolutely.
The reason I ask is because the whole idea with these tariffs, at least from the president's perspective, is to bring commerce into the United States, back to the United States. In this case, it's not like you can start producing more or extracting more copper from the U.S. to negate the need to import copper.
Right.
It doesn't seem like it has the same mechanisms that some of the other tariffs that he's implemented or talked about implementing have.
Yeah, it's a bit of a weird one. And we asked this question too, is like, why has Trump focused on copper? And, you know, one of the things is like, copper is technically kind of the Make America Great Again umbrella, right? Like copper, we have been, we still are a great copper producing country, but we used to be larger. The question becomes, can you get the mines up and running, and can you get the processing facilities to a scale that you'd be talking about to offset it? Honestly, I don't think the discussion has been, let's just like completely, change the way production is in the United States. The conversation has more just been, let's do this because we should. And listen, Freeport McMoran, Rio Tinto, like there are big names that operate inside this country. And sure, they'd probably be more than happy to start doing a little more production, mine production, more processing production. But, like at the same time, they're also shipping into the United States.
All right. I know there's going to be more to come. We know we could probably talk an hour with you, but you're just going to have to hopefully come back tomorrow or something. Joe Deaux, thank you, because it certainly is top of mind for us on this Wednesday. Bloomberg News, Metals and Mining, heavy machinery reporter Joe Deaux joining us here in studio.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Borrowers are piling into the global bond market, and what they're looking to do is get some deals done ahead of U.S. President Donald Trump's plans to impose global tariffs on April 2nd. Tariffs have been top of mind once again today. So global bond investors really kind of looking to take advantage of this week's relative calm in the market.
That was before today.
I was thinking about this when I was reading.
Relative calm, Carol.
I know, exactly. It was kind of mellow for a while.
But the bond market's mellow today.
Yeah, I guess you could say. I feel like tick, tick, tick. We're waiting to see what's next.
With more, we got Rajeev Sharma with us, Managing Director of Fixed Income Investments over at Key Private Bank. It's a division of the publicly held $18 billion market cap bank, Key Corp. $60 billion in assets under management for Key Private Bank. Rajeev joins us in the Bloomberg Businessweek studio. The fixed income market, we know lots of moving parts. The headlines, though, the developments that you're following the most closely, what is it?
There's been so much uncertainty in the market. There's been this big push for, are we having a growth scare? Is there going to be a slowdown in the economy? And what we're really looking at here is this is the opportunity right now for investors to look at asset allocation, how their portfolios look, and that's where fixed income comes into play. When you start seeing all this volatility in the market, you see most of it on the equity side, We haven't seen that level of volatility on the fixed income side.
Right.
So it gives us a good opportunity.
All right. So in terms of specific metrics, though, that you keep an eye on, and I understand the low vol that you're saying, or the different volatility we're seeing in the fixed income market, is it, though, Fed policy? Is it tariff policy, Washington policy? What is it, like, top of mind? You get up in the morning and you're like, tell me what's going on.
It truly is all of the above, because what ends up happening is you get the tariff headline policy, which is almost on a daily basis. That does spook the market. It causes a lot of uncertainty in the market. You start seeing the effects in equities. What's really been interesting is the credit markets, if you look at credit spreads, they have been very well behaved.
Right.
They're not screaming any signs of recession. They're not screaming any signs of a slowdown. That has actually become a nice barometer for other investors, equity investors, to look at. As long as there's nothing wrong in the credit markets, we should be okay in the equity markets.
My instant Bloomberg is blowing up with people who want to ask questions about fixed income to you. First one coming. Do you anticipate swelling from fixed income and that money then going into equities?
I think right now what we've seen in the past is the money market funds have done very well when they were getting good rates. And everybody expected that money to go to the equity market. That didn't happen. It's still at all-time highs.
But that money's still out there.
It's still out there.
Do you see more coming from the selling of fixed income, or do you see it more as like that cash and money market accounts is going to move somewhere?
I think it would be the cash and money markets accounts.
Where do you think it's going to go?
It'll probably go lockstep into fixed income first, because right now you're still getting corporate bonds that are very nice yields right now. You're getting blue chip companies that are trading at very good income levels. So it makes a lot of sense, really, because you can sleep at night without worrying about it's just going to blow up my portfolio.
So is it corporates that you see the flows going into more so than sovereign or treasuries?
We've been seeing a lot of investment grade corporate bonds do extremely well in this type of volatile environment. What's really been happening, these are really big liquid blue chip companies that offer you quite a bit of income with their coupons.
So you're not talking high yield?
We're not talking high yield.
Okay, go ahead.
If we were to talk high yield, I'd be very particular about what sectors I want to invest in high yield. It would have to align with the America First agenda. So you would look at maybe manufacturing or energy being very advantageous in high yield.
All right, but among the blue chips, where would you go?
On the blue chips, you're looking at consumer staples. You're looking at energy. You're looking at industrials. You're looking at anything that promotes the initiatives of the Trump administration about getting growth, America First, trying to look at maybe deregulation, which would be very helpful for financials.
In terms of what your clients care about, are they more focused on yield, or do they care about credit spreads?
Our clients care a lot more about yield. As long as you're getting yield, I think every investor has gotten really accustomed to being in an environment years ago when you weren't getting any yield in fixed income. Now you're getting yield again, and you want the clients really want that yield again. What's very interesting, however, is you can get that yield in very high quality securities now. So you don't really have to go down the credit rating spectrum to achieve that kind of yield.
What's the risk? Austin Goolsbee, president of the Chicago Fed, telling the Financial Times in an interview, the Fed is no longer on the golden path witnessed in 2023 and 2024. Fed had now entered a different chapter where there's a lot of dust in the air. And he says he believes borrowing costs would be a fair bit lower in 12 to 18 months from now. Cautions it may take longer than anticipated for the next cut because of economic uncertainty. How does maybe it being a lot of dust in the air, like you said, there's a lot of things every morning, how does it complicate things? And how do you ultimately figure out when to kind of, push the button on an investment right now?
Well, the markets have been generally thinking about the mantra, you don't fight the Fed. And right now, the Fed is in a wait and see approach. They're not looking to cut rates right now. They have the luxury of waiting. So they're deciding right now, we're going to wait for more data. We're going to find out what the fiscal policy is before we start cutting rates. The market, however, is once again trying to dictate terms. If the Fed came out last week and said we'll have 2 rate cuts for 2025, the market is leaning towards 3. So that dislocation is one of the worry signals for us, because that has to resolve itself. And that's going to resolve itself, but we'll go through volatility to get there.
So what is your outlook on the rate path for the next 12 to 18 months?
I do think that we will have a continued rate cutting cycle, but I think it's going to be later in the later part of this year. We probably will get 1 rate cut this year, but what will have to line up will have to be a lot more clarity on tariffs. You'll have to see a lot more inflation data that kind of supports the trend towards the 2% goal, and you need to make sure the jobs market stays stable.
Are you concerned that the tariffs are inflationary?
Yes, I am. Tariffs are generally inflationary. It was interesting to see Fed Chair Powell note that in his FOMC meeting press conference. So everybody knows that tariffs could be inflation stoking, but he did come out and say that he thinks it's going to be a short-lived inflation.
I believe the term he used was transitory.
I didn't want to use it.
I know. Don't say it. Do you buy that the president will ultimately get to growth later this year, and the idea being tariffs first and then a cut in taxes and easing regulatory oversight later in the year? His Commerce Secretary has talked about growth later this year, a dynamic, perhaps, economy, maybe not his word, maybe my word, but just a stronger growth in the United States. Do you believe in that plan?
I mean, it's a very good question. I think there's certain things that need to happen to get to the growth prerogative that he had set for himself, that he ran on his campaign for. But I think that's kind of getting muddled right now. I think it's going to take more time to get there than was earlier anticipated.
Well, what do you think is the catalyst for that? Is it tax cuts? Is it manufacturing coming back to the U.S.? What's the realistic part in your view?
I really feel like the tax cuts need to happen. I think that was the number one priority when everybody thought that was the number one priority when he was running. That's now become almost a third priority. And with that, I think growth gets a step back.
One last question, and it definitely relates to Trump policy, maybe less federal money going to the states at this point. What does it mean for municipalities and states in terms of their fiscal finances? Is it more issuance or is it more trouble?
I really feel like municipal securities is a great area to invest in fixed income. I think there'll be more issuance if we have infrastructure spending. And these are those kind of securities that do not get you rich, but they keep you rich.
What about ending tax breaks for munis? Is that on your radar?
It's on my radar. Those kind of conversations creep up every now and then. They don't really go anywhere. There's a big, strong lobby for munis to not lose that. So
I bet.
Shocking.
They are writing to their congresspeople right now.
People love their tax-free munis. Yep. Just ask some of the folks around here. All right, we're going to leave it there. Rajeev, thank you so much.
Thank you.
Rajeev Sharma, Managing Director of Fixed Income Investments over at Key Private Bank, joining us here in studio.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This feels like a big story.
Yeah, Bailey Lipschultz and Shireen Ghaffari out with some details when it comes to OpenAI's finances. The company expects to more than triple its revenue this year to $12.7 billion.
That's a lot.
I'm not paying for it, but I use it.
No, I'm not either. But there is a paid version.
Paid version, $20 a month. There's also $200 bucks a month.
I bet there are a lot of companies, right, that are tapping into it and using it.
Yeah. This is according to a person familiar with the matter. The company generated $3.7 billion in annual revenue last year, and they expect revenue to continue growing at a fast clip, more than doubling next year to $29.4 billion. Curious what Ruth Foxe Blader has to say about all this. She's founder and managing partner at Fox Capital. It's an early stage VC firm that she launched last year. She joins us from France. Ruth, good to have you with us. Have you invested in any of these LLM companies like Anthropic, OpenAI?
You know, I haven't, and that's partly because the fund that I run is not a multi-billion-dollar platform. I think that if you're getting involved with actually building large language models, you really need to be able and willing to deploy massive amounts of venture capital into these projects. And as we've seen, there are some really big incumbent tech players with enormous balance sheets who are also investing in these projects.
Right.
But certainly, pretty much every startup in my portfolio is moving its systems to run in some way on these LLMs. And there are an enormous amount of new projects that are coming to the fore in pretty much every industry, which will be based on these technologies.
Does it feel like a disadvantage, though, to not have the dry powder to be able to invest in some of these rounds? Or do you see opportunity bigger, earlier, and smaller?
I think what's amazing is that what these technologies are doing is really offering a new platform for reshaping the entire economy and probably, reshaping our society if we're honest about it. So the enabling technologies and that sort of critical infrastructure needs to be built. And sometimes it'll be built by, massive government investment, big technology companies with big balance sheets investing, the biggest VC funds in the world. But there's so much and just such an enormous, it's hard to describe how much opportunity there will be to use these technologies to really reshape every industry imaginable. And so there's more than enough opportunity for investors of all sizes. We certainly have dry powder. We're actively investing, but not in the models themselves.
Well, let's talk about some of the areas that either coming across the pitches, coming across your desk or in your inbox that are, connected to AI, artificial intelligence? Walk us through, Ruth, some of the things that are coming across that you're like, wow, this is going to be potentially a significant trend maybe in the years to come.
Yeah, we've seen a lot of early activity and early integration of artificial intelligence into the places where large language models really have a lot to say. And that's, things to do with language. So we're seeing a lot of activity in the legal tech area. A lot of companies are deploying large language models actively to do programming. So it's no surprise that the early adopters of technology would be technologists. And we're seeing just this tremendous ability to build companies that are much smaller. So a lot of the startups, even the early stage businesses that I'm seeing, it's just shocking how the size of company that you need to have from a full-time employee perspective to get to critical revenue is dramatically smaller than it was even a couple of years ago.
How's the fundraising environment right now from the perspective of a venture capitalist? Is it difficult out there to raise money?
So as a fund or as a startup?
As a fund.
The environment, I'm not currently raising capital, but, I have lots of friends and, the environment.
Aren't venture capitalists always raising capital?
Yes. And
Okay.
and actually, it would be probably indiscreet to, acknowledge anything around actual capital raises. But I am, not as actively in market as I've been in the past and will be in the future. So what I'd say is, there are big platforms, as I said, which are really well known, which really have no difficulty raising capital. Actually, raising capital as a fund is very similar to the experience of raising capital as a startup. Venture is a game of exceptions, and there are absolutely no rules. So, we've talked about big dips in startup financing in particular sectors, in 2023, 2024. We'll see what happens this year. But then we'll also see these absolutely huge mega rounds. There tends to be enormous bifurcation in the venture market. And, some people have it really easy and some people find it to be a grind, even in the most excessive of capital environments. Right now, there has been, I think, a little bit of an overhang from the venture capital bubble that we saw during COVID and the zero interest rate moment when people were kind of running into the private markets, and really there was quite a lot of capital running into all markets. And there's been a slight correction, but I think that there's still, there's still capital out there for interesting projects.
Ruth, I know when you shared notes and thoughts with our producer, Paul Brennan, part of the conversation, I think we've touched upon it, but this idea of a generational technology revolution with artificial intelligence. What exactly does that mean? What's the generational technology revolution that you anticipate is coming our way as a result of AI, which has been around for a long time, but obviously we're talking about generative AI, large language models, things that could really potentially already are and even more so change kind of how we do things in the future.
Yeah, what we're seeing is something really probably on the scale of the commercial internet itself. So the internet was around for a long time, and then, people started using it, and it just had this enormous impact on the way people do everything, the way they think, the way they research, the way they read, the way they shop, the way they interact with each other. And, we saw kind of the mobile replatforming and a lot of those same sort of large shifts happening and moving onto mobile. Here, I think that what we're seeing is not only the prospect of really changing unit costs. So what we were talking about previously, where you can just do a lot with fewer human beings in an organization, but that, potential to impact the revenue profile of companies. So definitely something that will change certainly how we value businesses and maybe the value that businesses are able to create. But it's also a social, it's a big social shift. And it's not just like, oh, are people using Perplexity instead of Google to search? It's really, where are people getting information and how are they comfortable communicating with machines? And I really see this not only amongst kind of people who are in the tech world, but even, folks in other parts of society who are actually asking ChatGPT for personal advice and, things that were inconceivable, really like Revenge of the Nerds, like having a relationship with a robot.
No joke.
Not
but,
great. You said no judgment. I said not great.
I know,
so
I know. Well,
some judgment, I guess.
I have to tell you, we were talking about you coming on in the newsroom, and we were just talking, as every day it feels like we have conversations around
All
AI.
right, just say it, Cece.
Cece, our producer, we were talking with, and we kind of came to, like, we really want to ask you this question. We're just going to go for it. I'm going to just go for it. How do we avoid creating a future generation of idiots, or at least individuals who can't write and think, if we're constantly going now? And I understand, having played with ChatGPT, you have to think and like how to get like different questions.
You mean like, okay, college students, Carol, using it to write term papers and stuff. Exactly.
Yeah. Like people who don't write, or at least get something started with something, with a chat device or something. Like, what does that mean? What does that look like?
I can't say that I think it's a stupid question. And I think this is what when I think about this technology, it's not only so impactful on the stock market and, in terms of sort of geeky tech innovation, I really do think that it is going to massively have a huge social impact. And, even when we think about, are we going to lose skills that we consider sort of near and dear to our hearts, like, writing and sort of thinking in the written word and communicating, or even just doing work unassisted, without sort of the kind of long arc of history in our computer that we can kind of tap into at a moment's notice. And there were those same conversations happening when the commercial internet came around, and the kind of dumbing down and the social crutch. But I think that these are questions that are really critical to ask. And you can take the point of view that technology is neutral and it's what we do with it, but we know that these new technologies dramatically shape our behaviors. And there have been enormous numbers of studies that have been done about the impact of social media on youth, or, regarding depression. And I see it with my own kids, just, the behavioral habits and the behavioral changes that have happened in, just a couple of generations are really quite crazy. And so there will be people who use these technologies to get even smarter and to do even more interesting things. But I think that this is a really big question: is what are we going to do if we end up creating technology which is so powerful that fewer people need employment in a world where there are, more people every year? And how are we going to really hold our critical values or continue to transmit values that we consider critical? And I'm sure that some of those values will go away. I mean, I think we're on the cusp of a really big social change too.
Yeah, it's tricky territory, I think, especially as a parent and thinking about this technology for kids. Ruth Foxe Blader, founder and managing partner at Fox Capital, the early stage VC firm. She launched it last year. I've been playing a little bit with Lily, the Duolingo chatbot.
And?
Well, my son loves it, and he's 6, and I don't want him to think that this is real life. It's pretty cool, though. It is pretty cool.
I don't know. Time will tell, right? This is Bloomberg Businessweek Daily.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we are just about 18 minutes away from the closing bell on this Wednesday. Carol Massar along with Tim Stanovic live here in our Bloomberg Interactive Broker studio here on Bloomberg Businessweek Daily. As Charlie just mentioned, we are kind of bouncing around our lows of the session, so down about 71 points on the S&P 500, down more than a full percentage point, about 1.25% to be exact, and down, Tim, just about 2% on the NASDAQ 100. We've been talking about some of these big mega cap tech names putting some pressure once again. But I think it's safe to say we're taking our cues constantly out of Washington, concerns about more tariffs, what it means specifically.
Well, let's see what Sevasti Balafas has to say. She's CEO at GoalVest Advisory. She's back with us. They've got about $600 million in assets under management. She joins us here in our Bloomberg Interactive Brokers studio. How are you positioning portfolios right now? Are you overweight cash because of uncertainty? What's going on?
Okay, so we're not overweight cash, but for people that have cash on the sidelines, new clients that have come in and they've had a liquidity event and they have cash, we are being slow. Our normal build out process would be 10 to 12 weeks, we're pausing on that. We're looking at 5 to 6 months in terms of deployment. Wow. So we're not rushing with cash right now. But for people that...
So leaving it in cash?
So leaving it in cash or T-bills or going into things like private credit, which have a lower volatility, or going into some structured notes, alternative investments, which we like and we can talk about, but not rushing into equities. So the equities part of the portfolio taking a lot longer to deploy that cash.
So the private credit part of the portfolio is something you would have done anyway. And you're like, it doesn't matter because we just talked about a story about how the private equity guys really want to tap into the 401k plans. But the thinking is it's going to sit there for several years. So it's okay to put it to work now?
Absolutely.
Okay.
The private credit, a couple of things on the private credit, lower volatility. And we do think even with all of this noise and uncertainty and a slowdown that we think is coming, we don't think it will be a hard landing, severe recession that we end up seeing. And so in that environment where default rates in private credit are not expected to be high, I like private credit. It's a slow and steady clip that we end up getting. So that's one thing, but you bring up a very good point. Within private markets, investors have a long-term time horizon, 401ks being one example, but even with taxable dollars, a lot of our investors have a long-term time horizon. They aren't planning on touching that cash for at least 10, 15 years out. For some part of the portfolio, having private credit and private equity is certainly appropriate.
Okay, that's a small part of the portfolio for most people.
Yeah.
What's typical right now in terms of asset allocation? Because there's been a lot of talk this year of concerns around this idea of American exceptionalism and then also outperformance in Europe.
Yes. So we are looking at, we've previously had an underweight to equities, and let me correct that, European equities. And so we've been neutral weight equities, and more of our portfolios invested in U.S. equities, and that's been the case for a long time. So certainly this year you've seen a reversal of that, and European equities do look more attractive, but we are not overweighting European equities.
Why?
This is why we work.
That was in stereo.
Yeah.
Exactly.
Okay. A couple of things. I think the reasons why, so European equities have had low relative valuations compared to U.S. for a long time. They've had lower valuations for a reason. Reasons why we didn't prefer European equities 6 months ago are still there. Things around demographics, for example, or things like regulation being more onerous in Europe versus in the US.
Even if like Germany said about the spend, like that doesn't...
We love that. We love that.
So do you like Germany?
Germany and Europe overall, I do think that we'll see more spending. There's been this aha moment where all of a sudden Europe collectively realizes we need to spend more. And so I do think that'll happen. But at the same time, and I do want exposure, and we are adding to our underweight that we had in European equities. We are adding to it, but I still don't think that European equities are going to outperform the U.S. equities over the long run.
You're not at the gambling table and like you're not all in.
Not all in.
So when you say you add in, I always am curious about percentages, right? Like how much is typical for Europe and how much more have you done?
Okay, so typically the benchmark weighting for European equities or international developed equities, I should say, is about 30%. So if we think of a 100% equity portfolio, about 30% is the benchmark weight towards Europe. We've been less than 10% in our 100% equity weighting. We're closer now to about 8% in Europe, in international developed. So we're still underweight, but we've increased our equity allocation.
Then 92% U.S. equities?
Yes, and the 100%, yes. So some in private markets, a lot in public markets. But the other area we like,
so some are in
dividend
private
stocks. Yes, some in private markets, but look, U.S. equities.
U.S. equities have worked really well for the last dozen years.
They have, and especially tech. But what we're seeing now, and this is also another area that we're investing in, so market S&P is down year to date, and it's certainly like since the peak Feb 19 or so it's down. If you look at dividend stocks though, for example, they're actually up. So there are plenty of areas or sectors in the US markets that there's still opportunity there, and I feel more comfortable investing in.
So you're all in on the US
equities.
It's interesting, right? So the idea of we've had a lot of conversations about American exceptionalism. Yes. Do you think that ultimately policies out of Washington will settle down?
I think we've been hit with a lot of bad news first in terms of, when the president got elected, there was a lot of talk of, and you saw an increase in performance because of talk on deregulation, pro-growth, tax cuts that will be extended. We've started now we saw a lot of policy and shakeups in alliances, and I think we've started with some bad news. So tariffs certainly being one of them, because they have caused a lot of this uncertainty, and it will continue until we have things figured out. But I'm excited to see about the tax cuts that get extended, and maybe there's more of them. There's more that will come in the second half of the year that I think will be more positive once the uncertainty around tariffs goes away.
We're basically exactly where we were election day.
Yes.
Right now on the S&P 500.
Yes. So it was a lot of enthusiasm of what will happen. The agenda comes out. It's about, immigration and deportation, and then about the tariffs. And we don't know from one day to the next what to focus on. We were talking about Liberation Day, April 2nd, and all of a sudden it's auto tariffs today. So once this calms down, there's more clarity around the tariffs, we can move forward and talk about the more exciting pro-growth parts that will help the U.S. market.
Really cool stuff.
Yes.
Always interesting, and especially in contrast to some of the stuff we've had as of late.
Sevasti Balafas, CEO at GoalVest Advisory, back with us here in our Bloomberg Interactive Brokers studio. Sevasti, always good to see you.
Thank you.
Thanks so much for coming in, too. Good to have you here.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.